A question that we are asked all the time, other than how do you get shirts as awesome as Reg, www.blockpartytrading.com/shop, but other than that, mainly from newer people in crypto, is they're always wondering, is the market too far gone for me to invest in a long-term position? Or short-term position, the only thing that I can profit in right now? Am I buying in at the top? The answer is actually relatively simple. No, you are definitely not buying in at the top. There is so much growth left for the rest of crypto, you don't really have to worry about it too much. But short-term, we could still see corrections, and quite possibly some big ones. So if you are going to take some long-term positions, you probably want to do a couple things to kind of, minimize the risk and maximize the reward, perhaps? Huh? What an idea, right? Crazy. I know. Key concept to understand when we are talking about long-term positions, we want to understand the concept of dollar cost averaging, or DCA. Dollar cost averaging is, by its very definition, buying into an asset, usually a volatile one, in small increments over time or at set points, rather than buying in all at once. This reduces the asset's overall volatility and the impact that it has on your holding price, i.e., if you buy it at the top, a whole bunch of it, and it dumps, and you got no more to buy at the bottom, you're kind of stuck with that position at the top. If you bought a little bit at the top, a little bit halfway down, a little bit at the bottom, your average price is right in the middle, you're in a much better position in the long run. Seems very simple, right? And that's the beauty of it. It's one of the simplest strategies, and it's one of the most effective strategies, and it's why we've built it into quite a few of our strategies. Makes sense, right? So how can we take this concept of dollar cost averaging and apply it to somebody just entering crypto and trying to take some long-term positions? Well, there are two ways. The first one is pretty, you just apply the DCA, right? You buy in a small amount now, you wait a bit, you buy in some more. Or if it drops a bit, you buy in a little bit more, right? Like a slightly bigger amount. And then you just wait patiently for your dreams to become a reality and take profits, damn it. But let's be honest, most of us would rather profit now off the short-term movements and make a shit ton of money off these big, massive explosions in price, right? Right? So that's where our second technique comes in. For the second way, all that we're going to do, we're going to buy in a little bit into the positions that we want long-term, but we're going to take most of our money and we're going to put it into short-term trades, like swing trades or DCA bots or something that's going to give us, quicker money, a quicker turnaround on that profit, basically. Then the profit that we make off these deals in the short term, we are going to then move over into our hodls, DCAing into the hodls over time. And of course, we always want to leave enough in the swing portfolio to cover any losses that might occur, that kind of stuff too, because obviously there are going to be some red weeks in the swings, you're going to have to make them back. If that's the case, don't be taking money out in your long terms. Sorry, you just can't do it that week. It happens. Now, what this gives us is a lot more flexibility. So if the market crashes, then we're not super heavily exposed into a whole bunch of stuff that we've bought in at the top at right away. And if we've got the extra profit laying around during a dump, then we can go ahead and pick up something that we've been meaning to pick up, get a whole big bag of it. And if the market goes up, then we're also not missing out on any opportunities because we have a small long-term position. So if that rockets, we've still got something that we're getting out of the deal. And we're taking all these short-term positions that are going to be profiting off of a potentially short-term uptrend. Who knows how long it could last. Then you just take your profit out of that and trickle it into the long-term positions. $1 now, if it 10x's, $10, whenever that may happen. But at least you're not putting aside money that you're already using to make more money, right? This helps compound our gains further over time. It helps reduce some overall risk in terms of market exposure. And most importantly, it gives you something kind of fun to do, because then you can kind of divvy it all up and you got your little bots going and then you got that going. You kind of move your profit around and feel like a regular Wolf of Wall Street type fella. Oh, and it keeps your funds a lot more fluid so that you can make those opportunity plays when you get them. Pretty sick. If you would like some long-term and short-term positions to perhaps build this strategy around, we may know of a couple people who do this thing professionally. Those guys. We even got Cornix integration now, so you don't even have to lift a finger. Just let the robots all do it for you. Your little robot army out there making you money. The BlockParty robot army. Don't forget who gave them to you. You're rich. This is just one part of the overall strategy that we use in BlockParty Trading to try to compound our gains as much as possible, and why we offer so many different ways to work the market and to make money off of it. If you would like to check out everything that we have that you can use in your strategies and all the information that we have on everything, check us out online at www.blockpartytrading.com. And as always, this has been Reggie George. Party on.